Boom! What is up, Waves Capital? It's Royce Jacob. Welcome back to the channel. In this video, as you already know, we are going to be talking about the ripping hot inflation report that just came out and what that means for the markets moving forward from here. Because this is a trading focused channel, I will also, of course, be talking to you guys about how I personally plan on navigating this macroeconomic environment over a short to medium term time horizon, and hey, maybe even include some longer term investment talk as well. Okay, so let's get into it, you guys. We'll quickly go over each of the tabs that I want to discuss with you, and then we'll dive into each one individually. To kick off the video, I want to read over the macro analysis newsletter that I wrote for the portfolio and newsletter fam this morning. Okay, this goes over my general thoughts on that CPI report that came out. And once again, I also include some talk about how I'm personally planning on navigating the short to medium term. Okay, so we'll kick it off by reading over this. Got a few good graphics to go over as well. Of course, we will include some Fed talk and how I think that they're going to tackle this scalding hot inflation report. And this will be just be a good groundwork for some of the specifics that we get into after this. Okay, so the inflation report itself, we of course have to dive into that. CNBC, inflation rose 9.1% in June, even more than expected as consumer pressures intensify. Okay, so we will be reading over some key points here, short and sweet, just let you guys know what this inflation report, what the CPI data actually showed. Okay, and then comes in some analyst expectations of what might come from here when it comes to the upcoming Fed meeting. Okay, so CNBC Pro, hot inflation leads some banks to speculate on a monster 1% or 100 basis points rate hike this month. Okay, so we'll go over this, you guys, some good analyst feedback in here and why they believe that a 1% rate hike is on the table when it comes to the FOMC meetings or when the Fed meets up come the end of this month. And we'll also go over some dates to be looking out for as well. Okay, so that's that, you guys. To close out the video, we will be taking a look at the SPY or the S&P 500 Spider ETF. The reason for that being the S&P 500 is the king of the US equity markets. Therefore, the price action of the SPY will ultimately have a significant impact and really just be a significant determining factor of the general direction of the US equity market as a whole. So we'll take a look at the S&P 500. I'll talk to you guys about why this chart is reinforcing my bearish fundamental opinions right now, and I want to talk to you guys about some downside price targets, and once again just give you guys my general thoughts on the markets, on some of the names that we've been covering, on growth sectors, on large caps, on small caps, and yeah, we'll just cover that as we close out the video. Okay, I gotta button this back up because I felt it unpop. Okay, by the way, let me know. Do you guys like the little summer dress shirts? I figured new office, just spice it up from that black shirt that I have literally 30 of. Okay, so if you guys want the black shirts back, please let me know. If you guys like the dress shirts, mixing it up a little bit, let me know as well. Okay, so that's the video, you guys. Before I get into it, please give the video a like if you do go on to gain value from it today, and subscribe to the channel if you want to stay up to date with everything going on in the markets. If you guys are still around, if you're still spending time educating yourselves during the boring times, during the hard times, during these winter periods, winter in the summer, you guys are the real ones. That is really a determining factor of who will be the winners and the losers in the long run, and who will be wealthy and maybe not so wealthy in the future. Okay, so props to you if you're still standing. Let me know in the comments down below how long you've been involved in the markets and how you're feeling about the markets right now. And I always love hearing feedback from you guys. So look forward to talking to you downstairs in the comments. Inflation surges to a new 40-year high. Okay, so the CPI or Consumer Price Index inflation report has been released, and that puppy was scalding hot. So hot, in fact, that year-over-year inflation has officially reached a new 40-year high. So we'll take a look at this quick, okay? U.S. Consumer Price Index year-over-year changed since 1970. You can see as of June 2022, we are now at 9.1%. The last time we saw that level was in the early 80s. Okay, so pretty crazy to think about that, and I believe it's 41 years specifically since we've seen inflation this high. And it's high right now, you guys, but when you look at how crazy things got in the 70s and 80s, just remember that it is possible for things to get worse. Personally, I don't think, given the fact that even over the second half of June, we saw energy prices go down, oil prices, gas prices started to fall. So hopefully this is the peak. But just remember, you guys, always proceed with caution. I'm personally remaining cautiously optimistic on the longer term from at least from an economic perspective. I think the markets are going to be punished over the course of this Q2 earnings season. If you guys watched the last video I posted, you would know why that is. But as of right now, inflation is hot. I personally believe it will begin to cool down over the coming months. But just remember, you guys, it is possible for it to get much hotter. Like up here, inflation in 1980 did reach 15%. So if we do see something like that again, if the U.S. becomes the new Venezuela, then that would be dangerous. And again, you guys, it's important to keep your portfolio protected during times like this. Okay, so let's finish reading this, and then we'll dive into some specifics. So inflation is at the highest level it's seen in 40 years. The US dollar, or the DXY, is at the highest level it's seen in 20 years. And the Federal Reserve is taking action to actively send the economy into a recession at a pace that's never been seen. Following this inflation report, many banks and institutions are speculating the Fed could potentially announce a 100 basis point or 1% rate hike at their upcoming meetings from July 26th to July 27th. According to the CME Fed Watch tool, traders are currently pricing in an 80% chance of this being the case. And we will revisit some of these metrics in this article right here, okay? So JP, Jerome Powell, Uncle Jerome, not happy with this one, not in the slightest. And again, you guys, at this point, if the Fed doesn't come in guns blazing, they're not doing their job, and no one wants to look like an incompetent moron, which unfortunately the Fed has kind of already been displaying. Okay, so I stated the following in yesterday's newsletter. This is a quote. In the case of the inflation reading tomorrow is above 9%, analysts estimate 8.8%, then I think the markets will be punished, but if it prints a reading below 9%, then I think the market will see some relief. As we know, the read was above 9%, and although the markets aren't necessarily being punished at the moment, I now feel far more confident in the macro price direction of the short to medium term, and that direction is down. It will be interesting to see how we close out the week. In the case that we see a bit more relief, I will continue to capitalize on my puts. Today's news provided some clarity to a market that's been extremely foggy, and as traders, clarity is an amazing and lucrative thing. Okay, so you guys, if you, I'm sure you know where we're going with this, but today, you guys, given this data, given this scalding hot inflation data, it's pretty clear to me that considering there was nothing good about this news, and if we're not going to go over the entire report today, but there was very little silver lining in this inflation data. Again, we could be cooling down. But there's nothing it's complete speculation to believe that this is the top. Okay. And again, optimistic, but the reality is there are no signs that inflation is slowing just yet on so many metrics. Like gas, the price of gas may be coming down a little bit, but there's still so many other factors involved with this CPI data. Groceries, eating out, the price of cars is skyrocketing. The price of everything is continuing to go up. So again, stay cautiously optimistic, but given this data, it seems clear, especially with, once again, Q2 earnings on the horizon. Delta just announced today that they disappointed. The banks are coming up over the course of this week, which of course we will be covering in the newsletters over the course of this week. But again, you guys, I'm personally staying very hedged. I'm actually capitalizing. I capitalized on some puts today, and I will continue to capitalize on these puts given the fact that I have been expecting this, and now it's time to really take action. So if you guys want to know how I'm personally trading on a day-to-day basis, you want to join Waves Capital for real, you want my daily newsletters, that's going to be the first link down in the description box below. That is $15 a month or $40 for every 3 months, completely up to you. But join the fam, you guys. Subscribe. You can always unsubscribe. I trust you won't, but I'll let you be the judge of that, okay? So once again, daily breakdown of my entire personal portfolio, the Waves Capital portfolio, updated every single trading day, and every trading day as well, You get 3 newsletters, the first of which is my Trade Alert newsletter, followed by the macro analysis newsletter that I write. Again, this was just this morning, write one of these puppies every day. And then lastly is the Price Targets newsletter, where today we cover Tesla, Editas, Matterport, Bitcoin, and Wrap Blockchain on the charts, give you guys some updated real-time price targets, okay? So once again, first link down below. Appreciate it if you guys check that out. But if not, no worries. I appreciate you watching now. Let's get into some more specifics. So key points. The consumer price index increased 9.1% from a year ago in June, above the 8.8% Dow Jones estimate. Excluding food and energy, core CPI rose 5.9% compared with the 5.7% estimate. Costs surged for gasoline, groceries, rent, and dental care. Dental care is a funny one to include in there. But that's just an example of what I was just saying, you guys. Like, everything, the price of everything is going up. And just anecdotally, I'm sure a lot of you guys can attest to the fact that everything is more expensive. So again, it's absolutely not surprising, just if you're paying any attention to the cost of goods around you, that this CPI print came in over 9%. But again, the question from here is this the peak? Will things slow down? As of right now, the markets are actually not pricing that in, which is pretty scary as well. So adjusted for inflation, workers' hourly wages, and this is dangerous as well, fell 1% during the month and are down 3.6% from a year ago. Okay, so even if individuals are getting raises, the cost of everything else is more expensive. So if, say, you got a 5% raise, that seems pretty significant, right? But if you got a 5% raise and inflation is at 9%, that leaves you with 4% less buying power than you had a year ago, okay? So we are entering a very dangerous time. Of course, so much value has gotten destroyed in the markets and in the crypto markets. I saw Celsius just before I sat down to record this as I was doing the research for this. Celsius just announced that they have alerted U.S. officials that they will be filing for Chapter 11 bankruptcy, along with 3 Hours Capital, 3AC. There's just so much negative going on right now, and once again, there are very little bull arguments to make. The silver lining for the markets right now is in the case of the big banks, JP Morgan, Wells Fargo, Citibank, who are all announcing later this week. In the case that they impress, that could bring the markets out of the funk they're in and potentially bring further relief. But again, we'll dive into the charts as well. It's really not looking good from a technical perspective, and the fundamentals, the macro is just, it's inarguably bearish right now. Okay, so let's read over this quickly and then we'll dive into the charts. So again, monster 1% rate hike, not seen in a very, very long time, is expected now by multiple analysts. So an unexpectedly hot inflation print is spurring speculation at 2 major Wall Street firms on hefty rate hike at the Federal Reserve's upcoming policy meeting. Nomura economist AAA said the data-dependent Fed will have to act even more aggressively in light of the scorching price pressures. Quote, "We believe that outright acceleration for the second consecutive month will likely encourage participants to now push for a 100 basis points hike. That may be particularly true considering one of the major drivers of the upside surprise in June was rent inflation, which remains a driver of overall trend inflation measures." Robert Prelli, head of global policy at Piper Sandler, also believes that the June CPI data cemented the need for an aggressive Fed. Quote, "Don't be too surprised if the Fed hikes 100 basis points this month," Perley said in a note. At a minimum, a 75 basis point hike. And remember, you guys, 0.75%, 100 basis points is 1%. Is a given at the July 26th, 27th, mark the calendars, FOMC meeting, but a 100 basis point hike will likely be on the table. June's consumer price index came in one last time at 9.1%, well above 8.8%. That was expected by economists surveyed by Dow Jones. That was the highest pace since, November 1981, so 41 years. 41 years. It's crazy. The Fed's next policy setting meeting will be on July 26th, July 27th once again. Following Wednesday's hot CPI report, traders are pricing a nearly 80% chance of 1% rate hike, according to CME Fed Watch Tool. And last month, the Fed raised its benchmark interest rates 0.75 of a percentage point to a range of 1.5 to 1.75%, in its most aggressive hike since 1994. So, If a 0.75% hike was the most aggressive since 1994, I'm going to assume that a 1% or 100 basis point hike will be the largest since, likely since we saw those levels way back in the day. Angry Jerome, again, over 40 years ago in the 80s. I'm going to assume, I don't know for a fact, but just given the nature of this chart and just common sense, I'm going to assume that the last time we saw a 100 basis points hike was back in the 80s, which is just crazy to think. We are entering a new, this is a paradigm shift, you guys. And I keep saying this, and this is very important. Do not fight the Fed. We said this a lot on the way down. Jerome's angry. He was happy when the stock market was going up. They kept everything from falling. They literally inflated the markets. They injected liquidity into the markets. You throw, like, the Fed has the ability to, they pretty much just added zeros to their balance sheet, right? Because it's all digital. They're not actually printing cash, but they added a bunch of zeros to their balance sheet. With those extra zeros, they sent out stimmy checks to retail investors who ended up propping up the stock market. They bought assets. They actually purchased stock, which they are now unloading. And again, you guys, at this point in time, the Fed is actively working to put the economy into a recession, to destroy demand in order to kill this scalding hot inflation. Okay, so again, if I haven't reiterated my bearish fundamental beliefs enough, then I'm not going to continue doing that. Let me know down below, you guys. What are you feeling? Are you in agreement with this macro bearish sentiment? Or do you think that the markets could see some further relief? And of course, let me know why down below as well. But from a technical perspective, again, the SPY, pretty much the benchmark. If you want to sum up the U.S. equity markets in one chart, it is the SPY or the S&P 500. And right now, the SPY is actually well down in after hours. Let's actually take a quick look at go CNBC homepage. Futures are well down. And of course, you guys, futures are not always completely accurate, but just given the nature of the markets right now, the futures, but this thing just keeps popping, man. Chest wants to show itself, but futures are well in the red right now. And again, it's difficult to be bearish, and it's crazy. And again, I was actually really excited about that opportunity that was presented today when some of my puts were on sale, so I could capitalize more on some of my puts. Tesla. But okay, you guys, the S&P 500, the SPY, once again, the benchmark chart for the U.S. equity markets did officially close the day below resistance, or below the support, below this line of support, this yellow line, short-term support that we have been in since June 17th. So almost a month now. Boom, touch point, creating that short to medium term line of support. We did officially close the day below this, and once again, we are in after hours trading. We're down like somewhere around here. So we have officially closed a daily candle below support. That is objectively bearish from a technical perspective. 4-hour Stokes pointing down. Let's take a look at some daily Stokes real quick. Also just curled to the downside and below the EMA or exponential moving average on RSI. That is very bearish. And I do think that another wave to the downside is in the cards, you guys. Okay, so where do I think we're going? Let's get rid of that. Let's get rid of that. Why is that not? Okay, never mind. That can stay there, I guess. But what is my price target? So over the short to medium term, and I'm talking by the end of July, probably sooner, given the fact that I think earnings will catalyze this second wave to the downside. Over the coming week or two, which I guess is the end of July. It's already the 13th. That's crazy. But by the end of July, I'm very, very confident in the fact that the SPY we'll see about 340 or over 10.5% down from current levels. And that is to test this high over here. And what is this high over here? This is the high that we saw in February of 2020. In February 02 of 2020, second month of 2020, prior to the COVID crash, okay? Prior to the pandemic shock, okay? And this is simply to revert to the mean. When you think about the status of the economy, it's actually crazy to think that the S&P 500 is still well above. So actually, we can drag this over here. Let's reuse this. You can always make some good out of it. We are still 11.5% above, even after the corrections that we've seen. The S&P 500 is still 11.5% above where we were, the all-time high. And this is, again, this is just after ripping for a straight year, pretty much. We are still well above where we were in early 2020 prior to the pandemic, okay? So that's very important to understand. And so where are we above those 2018 highs? So September of 2018, almost 4 years ago. Do you think the economy is as strong as it was 4 years ago? I don't know how well you guys remember that, but just anecdotally, probably not, right? The economy is kind of in shambles. We were not having crazy recessionary talk in 2018. And currently, from the 2018 all-time high in the S&P, we are still up over 27% from those 2018 highs. So, do you think the economy, do you think the markets are 28% stronger than they were 4 years ago? Just think of it like that's a very basic way to think about it. And again, there's so much external pressure weighing down the markets right now. The Fed, inflation, demand destruction, again, consumer weakness, consumer gloom. It's so difficult to make a bull argument right now, and that is why I'm bearish. That is why I have puts in place. And always know, you guys, my money is where my mouth is. So once again, if you guys want to know how I'm trading on a day-to-day basis, again, updated every day, keep you guys posted. YouTube, it's summer, it's a little slower posting videos 3 times a week. But the newsletter is every single trading day, and I'm always there for the True Waves Capital family. So again, if you want to join Waves Cap for real, first link down below. But also let me know down below what you guys are thinking of the current market environment and how you guys are trading personally from here. If you guys are bullish, if you guys are bulls, let me know why. And if you guys are on board with me with some puts, with some hedges, let me know why as well, so we can choose to that. So I'll talk to you guys downstairs in the comments. Until next time, always remember, take action, make waves. Peace, team.